I'm going to go ahead and turn it over to Mykel Taylor, who has some information on Kansas land values and some of the impacts of the virus here that we've been experiencing. So she's been working pretty hard getting all that together for 2019 land prices. And so Mykel, take it away.
All right, sir. Thank you very much. Coming to you from a dark and stormy night in Wamego, Kansas, in my sewing/workout room, which I say to impress you, but I haven't sewn anything in about 10 years and, well, I don't work out. So it's now an office, and I think we're all adjusting to the newness of working from home for those of you that are doing that. It's pretty fun. Let's see, what else? What else do I want to tell you? Yesterday was beautiful weather here in Wamego. Turkey hunting weather. So my husband went turkey hunting and came back with a coyote. So how's that for you? Let's see, let's get to rolling. We're going to talk about land values and the impacts to the extent that we can about the COVID-19. What I'm going to do tonight is sort of lump together my typical land values webinar and a discussion of what's been happening recently with the COVID-19. So you're going to get a little bit of both. I didn't see any point in trying to separate those two things. So we're going to go through the slides and talk about the overall land values in 2019, as well as what we're seeing right now. So let's get started. That quick outline: state of the farm economy. We'll talk about net farm income, talk about land value trends from 2015 to 2019, and then we'll talk about COVID-19.
Mykel, if you could turn your video on, I think that'd be helpful.
I would, Rich, but I don't know how.
It's down by the mute button in the left corner at the bottom.
Okay, hold on. Video. Oh, yay, there we go. Okay, now I got to get back into, hold on. Okay, there we go. Is that better, Rich?
Yes, that's what I was after. Thanks.
Okay, so Kansas farm economy. Let's go with that. This is a chart that I have shown you guys a lot of times just to, there we go, just to give you a sense of how things have evolved over the last 20 years now in farming in Kansas. This comes from Kansas Farm Management Association data, which I'm going to give a shout out to Kevin Herbal and all the KFMA economists for giving me some preliminary data that I can share with you guys, which is really important. So what I want to show you is the way that things have changed over time. The first block of time that we're looking at is through about 2007 or so, 2000 to 2007, when we were typically for these enterprises of wheat, corn, beans, and milo, we were breaking even or losing a little bit of money from an economic profitability standpoint. So this accounts for all of your economic costs of production, your opportunity costs and everything, not just tax-based profitability, but the kind of profitability that accounts for all of those opportunity costs. And so that was, I guess, more of a long run situation where, you know, producers were kind of at that break even for the average producer. And then we moved to the next phase from 2008 through about 2013, 2014, where we were making really good money. And this is, you know, I ask people sometimes, what do farmers spend their money on when they've got money to spend? And they spend it on machinery and land. And so John Deere was doing really well during this time. There was a lot of machinery turnover, a lot of guys running new paint. And the other thing that they were spending it on was land. And we saw land values going up during this time very quickly. Then all of a sudden we have a drop off, and it doesn't just go back to the old level of profitability, but to a significantly lower level of losses to where we're minus 50 and higher on a dollar per acre basis for losses for the last several years. So that's 2014, 2015 through 2018. And then this is the most recent bit of news for the 2019 North Central KFMA returns. Wheat, we're right at break even. I think we're making $1 on returns to management. We're losing some money on corn, but we're making money on sorghum and beans. So that's actually a really good, okay, hold on. Sorry. That's actually a really good outcome relative to the last couple of years with only a small bit of losses on corn. So let's go to the next slide, perhaps. There we go. Okay. Net farm income. For 2018, this chart gives you another sense of that change in net farm income per operator, where we went from making $130,000 in 2014 to making about $6,000 per net farm income in 2015. And then it's worked its way up. In 2018, it was about $100,000. But as you can see over on the left, 55% of that what in 2018 was government payments. And if that's jumped up, we're estimating that to be around 60% in 2019. Kevin has told me that we can expect the statewide net farm income number for 2019 to be between 20 and 25% higher than the 2018 number. So it will be higher, probably around 120,000, maybe to 125,000. But 85% of that increase is due to government payments. So we're showing positive net farm income and even pretty decent net farm income, but a lot of it's coming from the mailbox, and we're cashing checks from the government. So that's not a good situation to be in. Who's buying farmland? Well, this is an interesting way to look at this. This chart sort of shows you, we had averages on the previous charts, but now we're going to show you that spread or that distribution of farms and who's making money and who's not in order to come up with that average. So you can see for 2017 and 2018, we have this really wide spread of farms, and you've got a big chunk, about 45 to 50%, depending on the year, that's less than $50,000 net farm income. And that's pretty important to know because average family living expenses are about $79,000. And so you've got a lot of guys that aren't cash flowing family living expenses, let alone being able to cash flow the ability to buy farmland. So what we're probably talking about here is the top 25% of producers being in a position to even consider buying farmland. And my take on it is that they're probably going to be pretty picky about the parcels that they're buying. It's going to need to fit their operation and probably be of high quality to invest right now because there's a little bit of uncertainty. Are we going to get another MFP payment or a stimulus payment in 2020? Are things going to turn around in 2021? We keep asking ourselves, are things going to turn around? And so far, it's not working in our favor. So that's kind of what I see as the ability to buy farmland is there are a lot of guys that just aren't able to cash flow and they're simply not in the land market right now. But for the ones that are, they're going to be pretty conservative about what they choose to buy. All right, so let's talk about land values here. We've got 2 new publications just posted today, the Kansas Agricultural Land Values and Trends on the right, which is a collaboration between the Department of Ag Econ and the Kansas chapter of the American Society of Farm Managers and Rural Appraisers. That publication, what it does is we take the raw sales data and just do summary statistics on it, like averages and mins and maxes and ranges and counts, and we put that in there on a region by region basis. So there's 9 regions to the state, and it gives you a real good sense of what's going on locally with regard to ground in different parts of the state. The way that we classify land in that one is a little different than the way I classify land in my other publication. But what I'll say is that we're looking at parcels that need to be majority non-irrigated in order to count them as a non-irrigated sale, or they need to be majority pasture or something like that. Whereas I'm able to lump everything in all in one in my other one that's on the left. That is the Kansas County level land values for cropland and pasture. I'm going to give a shout out to Daniel Schultz and Daryl Kaiser for letting me bring my kids out and take pictures on the combine this fall. So we've got a nice snapshot of my kids in the combine for the cover for this year's publication. The big difference here is that what I'm doing with these land values is I am putting them into a statistical package and running a model on them to kick out what average quality ground would be. So I'm controlling for some of the characteristics that we see in this land, and I'm controlling for things like soil productivity, rainfall, population density, parcel size, location, county location, etc. And that allows me to do some different things and to make some estimates that are different from the publication on the right. So we've got two of them. I want you to look at both of them and you know, get back to us if you've got questions or comments on them. But they both serve a purpose and serve a role, and so they're good publications to have. Here's the punchline, I'll guess, from the publication on non-irrigated or on irrigated and non-irrigated cropland and pasture land values at the county level. I average those across the state, and what I see basically from 18 to 19 is about a 7% decline in land values. That's adjusting for quality, and that's adjusting for parcel size, as I said, and some other factors. So it's not just looking at a simple average, although the simple average of the land values is still a decline of about 5%. Once I adjust for quality, we're at about 7%. Now you guys have to know that these are just estimates, and they reflect what's going on statewide. And I know that it's not always the same thing going on in your neck of the woods as it is in other parts of the state. So something to keep in mind is that oftentimes what we see in a non-disclosure state like Kansas is we see the auctions, and that's a very transparent way to see what's going on with land values, but it's not the whole picture. There's still a lot of land that sells private treaty, and you can't observe all of those sales, but those sales go into this estimate here, and that's where we're picking up a little bit of a decline from 18 to 19. The pasture land pretty much held steady. I consider a 1% decline to be a hold steady option. And what you can see in both the non-irrigated and the pasture is that we dropped off from 2015 to 2016, and then we've generally held pretty steady. The same thing goes with pasture. So a big drop off from 15 to 16, and then, you know, a holding pattern from then. And I've got to say that's pretty good considering when, you know, the chart that I showed you at the beginning of the presentation with all that negative profitability on a lot of our crops. So having land values hold steady or just slightly decline is still a really good outcome, all things considered. And I'll just note that the beige line on here is the USDA numbers, that's survey numbers. So that's asking people about what they think land values are doing in our area. And that actually is up a little bit from 18 to 19 from USDA for pasture land, and it's up a little bit for cropland. I'd say we're all within the margin of error generally, but I would put a little more at 7% decline estimated from the model. I would say we're flat to slightly down on non-irrigated land, and we're flat on pasture. What about the supply of land? This is something that I've been tracking, and I'm able to track because of the type of data that we use, which is just the flat out number of transactions. You can see in 2015 and 2018, we had nearly the same number of transactions, which was about 3,700 statewide. Big drop off in 2016 with the number of sales. That was when we were talking about having a lot of no sales at auctions and a lot of ground just sitting and not moving on as far as private treaty was concerned. We built our way back up in 2018 to pretty much a normal year, and then we've backed off a little bit in 2019 with the number of transactions. It could be, you know, when you look at the number of transactions and it's down, it could be a couple of things. It could be a lower supply of land on the market. There's just fewer pieces of ground for people to buy. Or it could be a result of soft demand for that land that's keeping transactions from occurring. with also having lower prices, I think that it's generally, in this case, we're looking at a demand issue, and that the supply of land is probably pretty steady from the last couple of years. It's just that we don't have the demand for it, because farmers continue to be the biggest purchasers of, or the most common purchasers of farmland. And with everything considered, they're probably not, they're not jumping on a lot of this land if they don't see it as being a really good fit with their operation. Okay, so here's what we wanted to talk about tonight, which is what are the impacts from COVID-19. So I can't show you land value trends because everything that's happened with COVID-19 has happened in the second quarter of the year, and I only had data through the first quarter of 2020. And I'll say that in the first quarter of 2020, nothing was terribly different than what was going on in 2019. So we don't have a way to measure what's going on. All I can do is talk to you about what I'm hearing around the state and talking to different people, and some of the things pieces of information that I've gathered. And then we can talk about this as a group afterwards, and we can try to answer each other's questions with regard to what we're seeing. But a couple of things going on. One is that with the COVID-19, interest rates are staying low. That's going to definitely keep the option of buying ground open to some people. We have a friend here who lives over in St. Mary's, works for a contractor. Ever since the COVID-19, they've had everybody that was on the fence about building a house is jumping in and saying, yeah, let's go ahead and build that house, basically because mortgage rates are so low. So at least in some markets, it's causing people to move forward with sales or with building. What happens when the stock market takes a tough turn and starts looking a little bit less attractive than it was? Well, some people are going to say, I would like to diversify the risk in my portfolio, and I'd like to have some farmland to balance out that risk. So that might also be pushing people towards farmland, is the state of the stock market. So then let's look and see what's going on locally. This picture comes to us from Terry Castens out in Northwest Kansas. I think this picture was actually taken in Southwest Nebraska at an auction, and there were exactly 3 bidders, and one of them is taking the picture. So they're doing their social distancing, but the reality is that most auctions have been canceled or moved online entirely, which tells us that it's probably going to see a bit of a slowdown in the market for sales, and or a change in who is doing the buying. I visited with a realtor here a while back, a few days ago actually, and we just talked about the auction markets and what was going on, and their comments to me were that when you go online, you actually can it makes it a little easier to advertise more widely, and you can get more bidders that are out of state bidders. And that's what is happening, is that for the auctions that he's aware of, they've had more out of state bidders than perhaps they would have if they had just advertised it locally. His comment was that they've also, in 3 different sales in the last 3 weeks, have had 20 to 25 bidders registered to bid on this land. So there is still some robustness in that market. When an auction actually isn't canceled and it goes off, you do have some demand there. So we'll take a look at that. I think in terms of the COVID-19 response, we've got to think about both the supply and demand factors, because they're offsetting a little bit. On the demand side, low interest rates, maybe some unappealing aspects to the stock market, and any stimulus funds that we get from the federal government, whether it be another MFP payment or some other type of program payment, are all going to push us towards buying land. So it's going to bring some interest and stability to the land market, but a low net farm income is going to keep the majority of farmers out. And so that's sort of an offsetting effect of their ability to bid for land. On the supply side, one of the things that we're seeing, and it's hard to get people to talk about this, but if you bring it up, they'll admit that they're aware that it's going on, is that you've got guys looking to pay off some debt, and so they're selling parcels of land to do that. And couple of things there. One is that stimulus money may help delay some of those sales by allowing those guys to pay off debt without having to sell a piece of land. The other thing that's going on is, I wanted to show you this, is the quality index on land that's being sold across the state. This is just a simple average of the land that's being sold, and it dropped again in 2019. And what's interesting is that I think you put this in the context of selling off a piece of land. Which one are you most likely to pick? If you've got to raise some funds to get rid of some debt, you're going to look at two things. You're going to look at the tax basis you have in that land, and then you're going to look at probably getting rid of the lowest quality ground first for your operation. Now, for some guys, low quality land is still pretty good land, but for other guys, that might be pretty poor quality land. And so I think that the supply of low quality land has increased somewhat in this market. I'll just touch on rents real quick because I know everybody's thinking about them. Most leases are probably locked in now for the 2020 season. But if you have the opportunity to renegotiate, lower cropland and pasture land prices could be possible just due to the lower commodity prices and the situation that we're in. You have a valid argument there with your landowner. But they're going to probably throw back at you if we do get another round of MFP payments. What about the stimulus money? And the thing is that if we get stimulus money, not everybody is going to need it to cover their bills. For some guys, it's going to be a little bit of extra cash that's going to allow them to keep their rents high and keep their rents above where they might be without that stimulus money. So it's an indirect way in which some of those federal dollars sort of make their way back to landowners. But it's just a reality of the market that we're in, where we don't want to lose farmland, and we may have a way to sort of help ourselves to the next year. So those are two offsetting things, again, with regard to rents. I'll open it up for questions here in just a minute, but I guess my final word on this is, I think that the land markets are in much better shape than they could be. I think that the stimulus dollars, the MFP dollars that we've had up until this point have helped. And as long as we get another round of those in 2020, I think that will help us as well. I don't see the market falling off abruptly just because of COVID-19. I think sales might slow a little bit while people sort of scope things out and figure out what's going on. But I think there's also a push with regard to those low interest rates to go ahead and close on land that they're interested in. That's good land. So I see some support to the land market. When you're talking about, so I assume that Daryl's talking about the land value estimates, and yes, it's what we have are actual land sales. So it's the sales are going to reflect the actual yields and prices of that parcel of land at the time that it was sold. So I don't put any yield or cash or futures prices into the model. Instead, what I do is I account for when it was sold, and I put in a productivity measure because I don't know the actual yields on that. So that what it gives you is an estimate with average quality land. And so if you look at the publication and you look at each individual county, you'll see that there's some variation due just simply to productivity as you move across the state. Okay. Keep scrolling down. All right, so this is from Pat Weisner. The lower the price of land, the greater the ability of the farmer to afford its purchase. Which is better for ag? Do you believe land prices are too high, and why are land prices at the level that they are? Okay, Patrick, thank you. Do I believe land prices are too high? I don't do any estimates of like, 20-year cycles or anything like that to say whether or not I think land is too high. But when you look at the change in land prices, which I usually put this slide up and I didn't tonight, I'm sorry. And you look at how high land values went up through 2015, it's pretty amazing to me, what we did. And the fact that it hasn't fallen off suggests that, yeah, there was some legitimate support for those land values being as high as they were. But I'll also say that because of the federal dollars that have come with the MFP payments for the last 2 years and probably for this year, that it's a false sense of the land values being that high, and that those stimulus funds are supporting land values perhaps a little bit more than we would see otherwise if we didn't have those, especially in Kansas. So that's what I take. Jim Graber, he's got a message to me privately. Can you take a long look at land values for 6 to 10 years from now after the dip in inflation caused by the massive amounts of money added to the economy? Nothing like asking an economist to project out 6 to 10 years. I tell you what, we are good at that. I think there will be a correction. At some point, there will be a correction because we can't keep putting federal dollars at this problem of profitability. And so I do think that there will be a correction, but I don't think it's going to be massive. We've already lost from 15 to now, we've lost about 20 to 25% of our land values on non-irrigated land in Kansas. When we looked at long run prices of commodities a couple years ago, Alan Featherstone and I looked at this and looked at the land values that would be supported by those long run price projections. We said that we needed a correction of between 30 and 40% for that to really be supported. We're already at 25. The world hasn't come crashing to an end. So I think there's still room for a little bit more correction and things, just given the long-term output. Louise, in 3 to 4 years do you expect high inflation or high interest rates? I don't think that interest rates are going to go up like they did. I showed that chart. I had a chart initially that went all the way back to the 80s, and that was 18% interest, and that was the last time that we were having a problem with profitability and land values and things, kind of crashing down. I don't see us going that high at all, and so I'm not going to say that I think high interest rates are anywhere there. Monty, any hints yet as to where the USDA relief money will go? Well, okay, I don't know that one. I don't know where the money's going. So if any of the other economists on the line want to pipe up on that one, I will leave that open. But again, the money is going to end up filtering its way to the least common denominator of all these operations. That's either going to be pasture land or cropland. Does anybody else want to respond to that, to Monty's question?
Mykel, this is Glenn. I will simply make a summary statement that multiple groups, the cattle sector, the dairy sector, the swine sector, not to mention specialty crops and so forth, all have submitted their ask into DC. And as a general statement, all those asks are billions, not millions. So billions with a B. The total ask exceeds allocation to date, at least for USDA to dole out. Exactly how they divide it up across industries and then within industry. So like cattle, you got to decide how to do cow-calf separate from feedlot and so forth. That is all yet to be determined and sits within USDA's jurisdiction to decide at this point.
Thank you, Rich. Or sorry, Glenn. I don't have
the other thing, Mykel, this is Brian Brigham. I might add in on the stimulus dollars. One thing that's been talked a lot about is the Small Business Administration's Paycheck Protection Program. Today they announced that it ran out of funding. So they're no longer accepting applications or approving lenders. And I do know that some farmers, at least here in Kansas, have tried to apply for it. Based off of the discussion we had last night with Senator Roberts and Representative Marshall, and then others that I have talked to here in Kansas, the sentiment seems to be that more funding will come into that program. So, but that remains to be seen if there are some questions out there about that.
Okay, thank you guys. We'll go to John Campbell's question. What's the debt ratio on ag land in Kansas today? Last I saw it was pretty low, which limits forced sales. Point well taken. The debt to asset ratio is not at 1980s levels, which is often what we're kind of comparing it to, because land values have stayed pretty strong. But I can show you charts where we accumulated a lot of debt, just the flat out level of debt going up over that period of really high profitability and remaining high. And then when you start to have a cash flow problem, the ability to service that debt falls off really quickly. And forced sales are not something that's happening so often that we're all, we're seeing it and we know what's going on, but it's sort of like we're talking about it in hushed voices, that we know of one or two that are happening here or there. It's something that we're watching though, because that cash flow problem is going to lead to people having to find a way to service their debt other than selling their crops or livestock.
Mykel, can I chime in here?
Yeah.
Yeah, you're right. The average debt to asset ratio is pretty low. It's in the 20% range, low 20% range, which is historical from a good number. But there's quite a range of those debt to asset ratios across producers in the state. We have several producers, that are probably about 0%, but we have a fair number that are probably like in the 30 or 40% range too. So it's really quite variable across the state.
Okay, thank you. Thank you, Greg. This is from Brandy. I'm a realtor that specializes in ag properties. That being said, I've been keeping close contact with Farm Credit and local banks to see where the sales are. And everyone I talk to says that so far they haven't seen any changes. And I assume you're talking about just in the last month or so, Brandy. And that's the only thing I've heard, other than talking about the auctions being canceled or moved online, is I was actually visiting with somebody that was out of state that said that they had we're seeing a bit of a slowdown in sales. But as far as other people I've talked to in state, the sales that have gone off have not, they've not tanked. They've not been no sales. They've not been really low prices. They're just sort of holding steady or slightly up from where, you might have expected them to be. So I don't think that the coronavirus situation is necessarily changing willingness to bid of those that are able to bid on ground. Again, with anticipation of that stimulus money coming in, I think that will reinforce some of those people being willing to bid on land. Okay, hold on, Louise. Does the state of, okay, we're gonna go, we already talked about Louise, so we're gonna go to Nancy Wright. Does the state of Kansas have any way to control how land is used? So we're talking about zoning laws. Your concern is people moving from urban areas to rural areas and interfering with farming. Okay, I've seen it happen in farming communities when lakeshore becomes resort areas. Some conflicts happen. Nancy, I don't quite know. I don't know that it's something that it's not, you brought this question up when you registered, I think, and it's not that I disagree with you, but I am not sure that we're going to have a mass exodus of people from urban areas moving into rural areas. That being said, it only takes one neighbor who doesn't like the fact that you're spraying and that there's, it's the wind's blowing just a little bit and it may have come onto their yard. So there's always the possibility that when somebody moves into a neighborhood and they're not familiar with farming and they're not, sympathetic to it, that there may be some problems. But I am not a specialist in zoning or any of those kinds of things. That would probably be more of a Roger McCowan question. So I'm going to have to yield on that one.
Hey, Mykel, Brian here.
Yep.
If I could go back to Louise's question, where it's on, will we see high inflation rates in 3 to 4 years?
Yeah, go ahead.
So if you look at 5-year and 10-year break-even inflation rates, which is basically what the market expects inflation to be in 5 years and inflation to be in 10 years, both of those measures are well below 2%. I believe the 5-year rate is roughly 0.75%, and the 10-year rate is at 1%. So at least the market, their expectation is to not have high inflation. But I think what Mykel outlined of looking at very low interest rates, the tremendous amount of stimulus, debt that is going out from the government, the Fed, corporations, businesses, we have that question of, do we have too much money, right? Because the definition of inflation is too much money chasing too few goods, right? So we definitely have too much money. The chasing question is really, do we have enough velocity of flowing through? That's a question. But there's another piece of this inflation that often doesn't get talked a lot about, and that's just real wages. We have not had really any real wage growth at all here within the United States. Right before we went into this pandemic, real wages were beginning to kind of tick up, but we just haven't had that. So we've had this tremendous money supply growth, but just really no inflation out there whatsoever. So from a Fed standpoint, when they're monitoring it right now, that's the last thing that's on their mind as they're making decisions. But you are correct. I mean, the stage is set. There is certainly a lot of money that is out there, and it's something to monitor. But at least what the market is saying, what the Fed is saying, in my reading of it, 3 to 4 years, high inflation would not be my expectation.
Thank you, Brian. Does anybody want to answer Alan's question that it appears that good used farm equipment is holding steady? Can you explain why? I'm going to open that one up to my colleagues.
Well, Mike, I'll take a stab at it first. Well, I think a lot of that has to do, I think, because the new equipment, I think, has been holding pretty steady too. Deere has some really good economists, and they've been able to kind of, I think, match their production with what's been happening overall in the farm economy probably up until about now. So I think the fact that the new equipment market hasn't really gone down any, I think you're seeing the same thing happen in the used equipment too.
Thank you, Greg. So from Nancy, has more or less CRP land that was set to expire in 2020 been reinstated? I don't know the answer to that question. I know that we upped the amount of land that we were going to allow in CRP in the last Farm Bill, but I don't know that with regards to 2020 expiring land, whether or not we've seen that. If there's anybody on the call that has, you'd be more than welcome to maybe chat a quick response to that, but I don't have an answer to that one. If anybody else doesn't, then I will let Glenn answer the livestock question.
So Mykel, I presume you're referring to Ben's question as it relates to distillers grains. So actually both Dan and I have responded to that in the chat. I included a link to a USDA resource. Yes, distillers grains have gotten more, dry distillers grains, expensive in recent weeks. The short summary there, I think, is reduced availability and some producers concerned that they're going to have less in the future. So there's some chasing that. But of equal importance beyond just recognizing that price going up is livestock producers are being forced to adjust their ration because just simple availability going forward is in question. So lots of producers are doing that to adjust and get dry distillers out of their planned rations.
Thank you, Glenn. I'm looking at Patrick's question. Do you believe ag policy should be directed towards lower land prices so that farmers can comfortably afford purchasing land, or should land prices not be a consideration in farm policy? You're going to get my personal opinion on this one. I don't necessarily think that we should be messing with the land market. It's pretty efficient. It reflects the profitability in land, and the long run expectations for profitability in land. So it's not something that I necessarily want to see them messing with. That being said, there are lower interest loans and loans that are a little easier to get for beginning and new farmers or young and beginning farmers. And I think that's the group that probably needs the most help getting into the land market. So I think that those kinds of programs are helpful for those particular groups, but a general policy, blanket policy that would affect land values is not something that I would be in favor of. Oh, okay, Dwayne, in prior years, there was some discussion regarding bankruptcies. Any significant changes with this trend? It's up again in 2019, but only by a couple of points. So I think we're up to 35 or 37 bankruptcies statewide, farm bankruptcies statewide in 2019. It's a relatively speaking high number that we haven't seen since the 2000s, but it's not a big jump up. Again, bankruptcies, we monitor them, we keep track of them, but they're not a leading indicator of the farm economy. They're a lagging indicator. So we don't necessarily expect them to tell us what's going on right now in the farm economy. We have to look at other measures to understand that. But that's a good question. Let's see. Terry Castens, thank you for answering Louise's question. What are some of the new interest rates happening on farmland from creditors? So you're looking for what are some of the, so I don't know, do we have a resource that would be a good one for looking at interest rates? I know that Brigham had something on his presentation, didn't you, Brian?
Yeah, and I just quickly went back to look to see how it's updated. I need to update that, but what it's looking at is the spread between farm credit bonds and U.S. Treasuries. And what we saw was at the end of 2019 and early 2020, that spread was narrowing. So farm credit bonds rates were coming down closer to U.S. Treasury rates. And I think many producers out there had an opportunity to lock in cheap, longer term money, and many did. But once this pandemic hit, we saw that spread shoot up. And so we talked about it that last time at the end of March, where we saw it kind of returning back to maybe pre-pandemic and actually really more early 2019, 2018, where the 10-year rate, I believe, was their 10-year bond was right about about 1% higher than, so that farm credit bond is 1% higher than the 10-year Treasury. And that's where it's kind of holding steady, maybe inching up slightly. So it would, at least looking at that, I haven't gone out to look at what actual rates are being offered at farm credits or at banks, but just looking at those spreads would suggest that longer term money is going to be going up. So that spread has kind of been pushed back up, and it's holding here where we're at currently today.
So Louise's question, Brian, how would you answer it? Should we stay with variable interest rates on long-term debt or go to fixed rates?
Well, okay, so there's a lot that goes into that. Right now, I think it all depends on where you're at in your mix. And it kind of goes to what you're comfortable with risk right now. I know during that period of time when we saw, I was coming off of the financial crisis and right around 2012, 13, there was a lot of incentive to be using a lot of that variable interest rate financing. And it held for a really long time because the Fed had interest rates held at the zero bound for an extended amount of time. Now, we're through that time, then we started to see fixed rates became more appealing, and we saw some switching from variable to fixed. Now we're kind of maybe starting to see that reverse. So to say that you should go out and switch right now to variable rate financing, maybe we're starting to head that way. It really maybe is too early to make those predictions. As far as to say, look, we got to, lock in some of this variable rate money and stay with it. That's just my opinion where we're at right now. But of course, it's going to be it's going to vary across farm operations, agribusinesses. It's kind of be what your comfort level is. But from my opinion, you need to have a mix of both. You need to lock in some money, and then you need to be looking at variable rates. And if this continues where we stay in the zero bound for an extended amount of time, that variable interest rate money is going to be more appealing. But it's going to take a little bit of time here.
Thank you, Brian. From Anthony, what is the relationship between interest rates and land prices? Normally, you would put interest rates into a land pricing model because it's the cost of money to purchase that land. And so you would expect that the more expensive that money is, the less that you can spend on that ground. But interest rates, as Brian mentioned, have been so low for so long that there's almost no, I don't want to say no relationship between them, but it's causing the land prices, they can go up with respect to profitability, and they're not necessarily being driven by interest rates, because the interest rates aren't really, they're not going up, and therefore causing problems with being able to pay for that ground. Brian, do you want to say anything else about that?
No, I agree. The one thing that when I worked at the Fed and when we were at the zero bound, you can think of interest, the interest rate is the cost of money. And then if you think about it in terms of a market, what market functions well when the price of that good is zero? Well, not many markets function very well. So I think that we're maybe returning back to that, where people are uncertain. They're not exactly for sure where they want to go. And you're going to have some of those investors, like what Mykel talked about with the stock market is so volatile, looking to go to more of a safe haven, and farmland could be viewed as a safe haven. But yes, the signals are mixed right now, but a lower interest rate certainly puts upward pressure on land values.
Thank you. I got a private message from Pete where he talked about the new CRP rental rates in the Farm Bill being lower than the old contracts, which is giving an incentive for people to break out their CRP ground and not re-enroll. And it's interesting. There's the combination of that, and then for a while there was just a lot of land that wasn't qualifying for re-enrollment, and it was leaving people with kind of a difficult situation to figure out what to do with that CRP ground. I was asked to do a talk up in Marshall County and Washington County with regard to this issue. And one of the things that struck me when I went to that meeting was that most of the landowners couldn't be there because they were in nursing homes or elderly people. And they had enrolled their retired farmland into CRP, and they had no intention of farming it again. So to have it kicked out or something like that is kind of an interesting dilemma for them. But as far as USDA giving the incentive to break out CRP into farmland, I don't necessarily know why they're doing that. I don't have a good explanation for that. So if somebody else has an explanation for why USDA is keeping that. I mean, one of the reasons that they're keeping the rental rates low on the contracts is to make them in line with the rental rates they see in the marketplace. But it does give an incentive if they're too low to break it out. So I'm not sure what the policy motivation is there. Okay, Cammie's question, Brian, can you answer that one?
Well, yes, I can. And Terry Caston's had that follow-up. And
oh, yeah. Okay.
Exactly right. That Pat Roberts did suggest that if a farm took a PPP loan, that would not reduce any future government stimulus money. And then when we had our PPP virtual roundtable, KFMA economists, their basically answer was they would be very, very surprised if that happened. They would not expect that to happen at all. So if you did apply for a PPP loan or expecting to do so, I would not think that would reduce any future stimulus payment. One thing that I would go back, Jim Graber had a comment of the Fed injecting $8 trillion and Congress injecting and having $2 trillion. Certainly, bodes like too much money chasing too few goods. The one thing I would add, and I have this on another video talking about the Fed balance sheet, the Federal Reserve, their balance sheet is exploding. It's going very, very high. But you have to remember who's on the other side, right? So that Fed balance sheet, that shows assets. It's approaching, like as Jim says, going up to 8 trillion. We see that rising very rapidly, but who's the liability, right? Like who's on the other side of that asset? And that's the banks, the commercial banks that are out there. But those reserves that the banks have on their balance sheet with those Fed securities, those cannot enter into our commercial banking system, enter into the U.S. economy. The Fed will not allow that to happen. So when you look at the Fed balance sheet, don't think that all of that money could go into and cause rapid inflation. I mean, that cannot happen. But don't get me wrong. If you look at, I was actually teaching my class on the economics of banking and was showing a graph just looking at M1. So the amount of currency, coin that's in the economy, and then look at M2. So the money supply that has more of a store of value and savings. My goodness, you just look at those charts and that money supply growth is growing at a rate like we have not seen for quite some time. So it's definitely there. The too much money is there, but I just want to clarify on that Fed piece that the Fed's balance sheet cannot enter in to the economy.
Thank you, Brian. I'm going to go to George's question on what does the farm payment look like this coming October for PLC and ARC estimate. Okay, George. When we talked about the payment that would be coming in October 2020 is the payment on the 2019 crop. And what it looked like to us was that we would be seeing a payment on wheat and sorghum, most likely, and it was questionable whether or not we'd see a payment on corn and beans. And the thing you have to remember is that even though prices have fallen, it's a function of how much grain is marketed each month and at what price it's marketed at in order to sort of calculate the monthly average price that goes into that marketing year average price. And so if folks pull back and don't market grain at lower prices, then what you have is a lower weight on that month's price going into the formula. So my estimate is that things haven't changed much with regard to our expectations for which ones are going to pay out and which ones probably aren't. But I haven't been thinking about the Farm Bill for the last couple of weeks. I've been thinking about land values, so I can't give you a better answer than that. Brigham, I'm going to let you explain farm credit bonds.
So the farm credit bonds that I was talking about before is the primary source of loanable funds for the farm credit system. So they sell bonds in order to funnel that money, then use that as loanable funds for farmers, agribusinesses throughout the farm credit system. So that's what they are. And we can kind of get an idea of pricing off of that for mortgage rates, land values, even operating lines. And I know there was Brett Henderson had on the 15-25 year on rates being 4.5% to 5.1%. As far as investments go, I would point you to your financial advisor to talk about that, to get some more information about how you might be able to go out and actually purchase those bonds. But that's what a farm credit bond is.
Brian, Terry has a PhD dissertation defense question for you.
Okay, so Terry basically brought up the fear of deflation, right? So what we're at zero, and some of the if everything did fall apart, um, you, you know, the question is, okay, so with the pandemic ending, and then Terry outlines that you would have for a deflation environment, right? So, you know, the value of our goods and services is actually declining, which is really catastrophic for any economy that would go through that, would be, you know, high unemployment and no wage growth. Is it a possibility? Sure. I mean, would I assign a probability to that? I'm not. I would probably put it at low, because we need more information on this unemployment. We've seen record high, historical high, never seen these before, initial jobless claims that are coming in. They continue to be north of 5 million. But how transitory is that? Like, how permanent, I guess I should say, are those unemployment claims? Because through this different stimulus money, they've adjusted it. I mean, self-employed people can come in and ask up for it, different hours worked. If you remember back in the talk I did in March 26th, is showing that was when we first got our report, you know, was over 6 million. But you got to look at those continued claims. So if we expect that to translate into mid-teens, you know, unemployment, like all of a sudden we're at 15%, I don't think we're there yet. The question is how long does this shutdown happen? How do we roll out the economy and get people back to working, and then they actually don't continue to claim that unemployment? So is deflation a fear right now? Absolutely. I think that's why you see the Fed coming in and just throwing money at credit markets and corporate debt markets to try to get them unleashed and trying to get them going again. Is it a fear that I would put? I probably wouldn't put a very high probability on that, but it is a good point.
So, Brian, this is Glenn. I'm going to ask an audio question of you, so we can make a dialogue back and forth to play off Terry's comment a little bit further. So this is a thought exercise for us all. Several essential, and I hate the term essential, but nonetheless, it's widely used at the moment, sectors are having labor challenges. And among the responses to that is increasing the dollar per hour rate as a way to encourage folks to keep showing up and so forth. Do you think there's any prospect for the current transitory response bumping up the X dollar per hour persisting post-COVID? Yes, no. And does that fit into the wage growth story? That's half that question.
Yeah.
It's not often that we take dollars back away from an employee that's an hourly once they're kind of on the table is what's in my mind.
Right. And what I would also want to know on the other side of that is how permanent are those jobs? You know, if we get through this, and delivery, for example, is a big one, and working grocery stores, getting food supplies out, will they stick? Or will that be fluid enough to where it could go back down, or that job just simply goes away when people are able to maybe go to their more permanent job, which would have other incentives for them, health, retirement, so on and so forth. So,
and slightly longer term, I think all the economists, at least on here, would agree those elevated wages bump up the incentive to invest in capital instead of labor. So you've got that to boot. There's multiple pieces to the wage growth component, not just the unemployment piece, which I agree with what you said on the unemployment, not disputing that. But I actually think we have some unique things on the wage growth piece too that are occurring we got to think through.
Well, and even beyond just the wage growth, just look at a lot of these factories and plants who have just grinded to a halt because of a pandemic. This isn't, a typical recession. So what if this happens again? I would think what my fear is on this unemployment is, will we need to have those folks who are not working start retooling and be a different type of worker to come back? Could we have some structural changes that happen? My guess is, with the wage growth side, what you brought up, but also too, just grinding to a halt, are they going to go in and start considering how can we automate things? How can we make things more fluid? I mean, you look at the cotton industry and how the textile industry just has seized up because of what's going on in India. How do we become more automated, right? And then that would cause our workers to have to, change their skill set.
Do you think that the pandemic is likely to happen again? I mean, is this a one-off, or do you think that the people don't ever want to be caught in a situation like this again, and it might happen again, therefore there's a need for that investment in capital to automate and lower your labor needs?
So Mykel, this is Glenn. I think it's important, at least in the ag industry. So a lot of what we're talking is, entire economy wide, but bring it back just to the ag industry for a moment. Every sector of the ag industry, I'll say for 10 years to be safe here, has had some labor challenges, finding sufficient labor, keeping them willing to hang around, on and on and on. And this just puts that on steroids in some sense. So what's going through my mind is this may be the straw that broke the camel's back, so to speak, to spur that additional quote-unquote automation investment. That doesn't show up overnight, but I do think it has implication to Brian's point on the possible retooling of a workforce that sees a notable change in the demand for their time. Not next week, but in the near future.
Brian, this is Dan O'Brien. Glenn, excuse me, this is Dan. How much potential this is a naive question, but is there great potential for automation in the meat packing plants, especially with them being hotspots for this type of disease outbreak?
So as I said last week, I'm not a engineer to tell you how fast we can make that swap. And a lot of our facilities are fairly old, so it's not easy to go into a dated facility and retool. So you've got those constraints. But I never say nothing's doable. Several people that have dialed in here are old enough to remember how the dairy industry operated before cows walked on a wheel. That's basically automated half of that process and replaced a lot of labor, right? So we can all think of lots of examples in our lifetime that have displaced labor. And I suspect that every sector is capable of doing more of that. How feasible is it tomorrow, Dan? Not real feasible because of the setup of those buildings.
Right.
But I think the incentive is pretty strong. It was there before. And to be quite blunt, unless it gets too bureaucratic, I think private capital will make those decisions.
Yep. Thank you.
We're going to go to Chetney's question on, as a non-farmer investor, should I buy farmland now or hold off? Also, why is land in Riley County continuing to increase in value while most of the rest of the state declines? Well, because Riley County has a lot of non-ag influences. When you look at the employers in Riley County and some of the growth that's going on, I'll point to the NBAF facility and sort of the anticipation that those folks are going to come in and the housing market is going to boom. And I'll be honest with you, there's just a lot of people in Riley who like to own a house in 10 acres. And so even subdivisions go in and they take up a lot of land relative to maybe some of those older housing subdivisions in town that are you get if you're on an acre lot, that's a big lot. But you think about the growth outside of town, and that's a lot of houses and some acreage. So just a lot of a non-ag pressure in Riley County. It's happening in Pot County as well. In terms of should you buy farmland now or hold off? I guess if I were buying land, I would probably, because of my risk averseness, wait and see. But that's a personal opinion too, because I think that there's the possibility that things might back off a little bit more, and we might see a little bit more of a weakening of the land market, but not by very much. So I don't think it's a bad time to be buying farmland. But those are personal issues, or not issues. I've got those, but that's a personal opinion. Now, does anybody else want to chime in on that? Come on, Brigham. Okay. Well, I tell you what, we're after 8 o'clock and the questions have sort of trickled down. And so I'm going to say that we did good and we're probably ready to be done for the evening. Last call, if anybody's got a question, I'll give you, okay. Thank you very much, everybody. Appreciate it. I think we'll call it good tonight then. Thank you very much. We're going to take next week off and not have a session, and we will reevaluate whether or not we've got more information to share with you for the weeks after that. So stay tuned. Rich will share information with you via Ag Manager if we need to, if we're going to have more of these talks. But thank you guys for tuning in. We really appreciate it.